Good afternoon, everybody. Uneducated Economist here. So, thought I would talk a little bit about the bond market. I was reading an article talking about how Ukraine had issued out some dollar bonds, and now they're having issues paying those things back. And this is something that I feel is probably going to be a more prevalent story in the news as time goes on, especially if the interest rates continue to tick up like they are. Now, you're starting to hear a lot of people, a lot of economists out there talking about the 10-year Treasury going up to 2.5%, even 3%. I saw one article saying something about 2.7%. And who knows if this is actually going to take place and how long it'll take to get there. But if it does, this is going to start creating some serious issues going throughout the rest of the economy, especially when it comes to the global economy. Now, a lot of people kind of think out there, they say the dollar is done, so many have been printed, it's on its way out. I hear it a lot that there's going to be this global de-dollarization taking place. And that very well could happen. I mean, I don't doubt the day will come that the dollar ceases to exist. I mean, I know that day will come at some point. It's not going to happen tomorrow, and it's not going to happen the day after that. And so to think that, yeah, the dollar is done, it's out of here, don't even second guess the idea of there being any kind of future with the dollar in mind. I wouldn't count the dollar out just yet. There is a lot of debt due out there in dollars, and a lot of people are anticipating on getting paid in those dollars. And there's not nearly enough dollars out there to pay for all the debts. So the demand for dollars is still going to be there. All right, so here it goes. Dollar bonds are issued in many, many different nations. China, Ukraine, I think Pakistan, I was reading issues about having dollar bonds right now. And the more the dollar strengthens to the basket of world currencies out there, the more difficult it is for these nations to pay back those dollar bonds. Remember we used to hear a lot about trade wars and currency wars, and you don't hear so much about that anymore, especially the currency wars. Don't think that they haven't gone anywhere. There's still currency wars very much alive and well out there. And the United States is the king of all currencies out there because they have the world reserve currency. When two nations want to do a deal with each other, they do it in US dollars. If they did it in any other currency, if they went to go spend that currency, the other nations that they go to spend it with may not accept the currency that they have. But they will accept US dollars. So US dollars are the world reserve currency, and there's nothing that's going to change that anytime soon. Will it go at some point? Sure. It will, something else will replace it, but that's not happening anytime soon. And so I think about what's happening right now with these interest rates rising, because not only is it going to cause a ripple throughout the world economy, as all these nations who have issued out dollar bonds are going to have to work ever harder to try and acquire the dollars they need to pay back those bonds during a time where you see the dollar index strengthening. That's the dollar gaining value against the basket of world currencies. That's why it's getting harder for them. So here in the United States, we have interest rates rising, which is doing something very interesting to our bond market here in the United States. And especially when it comes to the triple C junk, like highly junk rated debt. And that it's the most desired right now. See, all the rest of the markets, all the rest of the bond markets, you have two things you can follow. You can follow yield or you can follow prices. And now most of the time when you're looking at the news, they're talking about yield. And yield isn't the percentage that the bond pays. Yield is the percentage that the investor gets after purchasing the bond. The bond has a coupon. The coupon is the interest rate that it pays. So even though the price can change, the coupon rate stays the same. That's why what the investor is yielded after purchasing changes with the amount that the investor had to purchase, however much they, purchased into the bond. That's why the prices change, yields change, coupon, that stays the same, but nobody talks about coupon rate because it doesn't matter. All the thing that matters is the yield, how much the investor gets after purchasing the bond. Sorry, that was kind of confusing, but It's important to understand that in order to understand what's happening in the bond market, because right now you have yields rising on the safest stuff. Short-term US debt is the only thing that isn't rising at the safest levels. And now it's a little confusing, so just kind of understand this, is that when you tie your money up for a longer term, you want a bigger return for that. And so you go to the United States government because they are the safest place that you could ever possibly put your money. Like if you buy a 10-year treasury, you are guaranteed you are going to get paid back that money. And so anything after purchasing a 10-year treasury becomes risky, or it becomes riskier, because the 10-year treasury is a guaranteed, no doubt about it, going to pay. So if a corporation wants to sell a bond, it has to compete with the U.S. treasuries. And if the U.S. treasury yields are rising, well then so will the corporate bonds, as they have to compete against the U.S. treasury being the safest place. And as the yields begin to rise, the prices are dropping. And now this is telling the investors, this stuff isn't very safe. And where we need to go is a place that we can earn some money. And the only place where we really can earn some money right now is in the riskiest stuff, in that CCC debt. And that's where they're going into, because they can get a much higher return. You see what's happening here, guys? As the interest rates are rising on the safest, secure stuff, it's forcing people into that ever riskier place to try and get the return. As the interest rates are rising on this 10-year treasuries, it's causing the dollar index also to rise against the basket of world currencies out there, which is making it difficult for those people to have to pay their bonds back, all the sovereign nations out there that issued out dollar bonds. As this continues, it's going to be even more stressful on the global economy. But yet here in the United States, we have our own issues dealing with asset price inflations, house prices going off the charts. Over in Canada, they have, they're warning right now that they have a perception, like the people have this perception, 63% believe that house prices will continue to accelerate higher. 63%. And this is very dangerous because they're already overvalued, but everybody believes that they're going to continue to go up. As this continues, we are going to have some serious issues as people start putting money in the wrong places, in the riskiest places, like the CCC corporate debt. They're rated CCC because they're high risk, but yet that's where people are going to try and get a return. It's transitioning. At some point, if the interest rates continue to rise, what will happen is that the investors will no longer look at that high risk stuff as attractive as the risky or less risky treasuries, and the yields are rising on those become more attractive. Once they do that and they turn away from those corporations are going to be desperate for loans. They're going to be desperate to sell their bonds to somebody. And with the investors turning away from that, the yields are going to rise much higher than they can afford. And that's going to be very difficult on them, because they're going to have to pay back those bonds. And the only way to really pay them back is to either sell your own stock if you have it, or start cutting employees or whatever you got to do in order to pay back the bondholders. So, this is the type of stuff that I see coming. Anyway, I'm not sure how to end it, so I'll just end it right there. Uneducated Economist. You guys let me know.